Hey everyone, thanks for watching another Money with Michael video. Today we're going to be talking about what are calls and puts. I'll be going over definitions as well as some examples. Stay tuned. Okay, so let's get right into it. First of all, a call and a put are two different kinds of options. Now, an option is a contract which gives the buyer of that option the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. Now, I know that's long. Basically, we're going to be talking about stock options. So the underlying asset is going to be a specific stock. And so if you're a buyer of either of these options, it's going to give you the obligation to buy or sell that stock at a specified strike price and on or by a specific date. Now, for option contracts, specifically relating to stocks, they trade in quantities of 100 shares. So if you see that an option costs $1, you're actually going to be paying $100 for that option because that $1 price is going to be per share. So just important to realize that if you buy one contract, you have the right but not the obligation to buy or sell 100 shares of the underlying asset at a specified strike price and date. Now, every option has something called time premium. A lot of beginners with options, they think that it would make sense to just exercise the option when you're happy with how much you've made, and that is not going to be the case. With very, very rare circumstances that generally involve dividends, that could be, but for 99% of the time, you're just going to want to sell that option on the open market. You're going to make more money doing that, and I'll get into that a little bit later. Now, even though your option may not be exercised, you can trade it as the price of the option and underlying asset change, just like stocks. So just like you can trade a stock anytime throughout the day and the price changes, the option reacts the same way, and it's all relative to that underlying asset, which again is going to be the stock that you buy your option based on. So now that you understand what an option actually is, let's talk about a call. Now, a call option gives the option buyer the right but not the obligation to buy a stock at a specified price within a specific time period. So the seller of that option would then collect a premium and in return allows the option buyer the above right, which I just read. Now, if you look at this chart down here, this is going to be where you buy the contract. So if you buy a call, which again is going to be a long call, you kind of start out below your profit, because if the option expired right now, you would lose the premium that you paid for that contract. Now, in order to make money, the price of the stock would have to increase by more than the premium that you paid. So you can see here that if your strike price, let's say, is $100, and then let's say this is $110 right here, and you paid $10 for the contract, you can see here that if it went above your strike price and went to 105 and then expired here, you would actually lose $5. And I'll get into a math problem in a little bit that will sort of highlight that a little bit better. Now let's talk about a put. A put is very similar, but it gives the owner the right but not the obligation to sell a stock at a specified price within a specified time frame. So consequently, the seller of the option, again, collects a premium and in return allows the option buyer that right. So let's talk about a call option from the buyer's perspective. So let's assume SPY is trading at $300 and you buy a call for $1.25 with a strike price of $300. The price shown is on a per share basis, meaning the option would cost $125. I talked about that earlier, and again, that's going to be 100 shares. So time goes by. Now, SPY is trading at $305, which means that call that you bought is in the money. The option is now exercised because it expires, and you buy 100 shares of SPY for $300. And now we're going to assume that you sell those shares immediately. So you're going to have your $300 per share, so 100 shares. That's $30,000. You would then immediately sell those shares for a profit because, again, SPY is now trading at $305. So you would sell 100 shares for $305, which would give you $30,500. So you have the $30,500 and you have the $30,000, so that's $500 profit. But you can't forget about the price of the option. So earlier we said that call cost $125 per share, so $125. So you have to remember to take out that $125 that you paid for the option. So then you would end up with $375 of profit. So that $375 profit is great. Your max loss is going to be $125, whereas your maximum profit that you could make from this option is only limited by how high SPY will go. So let's look at this from another angle. So SPY is trading at $299.99 instead of $305, and the call is out of the money. The option will not be exercised, and you will not buy 100 shares of SPY for $300 because the market price is lower than $300. The call option has expired worthless. So again, you spent that $125 per share to buy the call, so your loss is going to be $125, which again is your maximum loss in a scenario like this. So let's assume you sold a call option. SPY is trading at $300 and you sell a call for $125 with a strike price of $300. Again, it's shown on a per share basis, so you would receive $125 for selling that option. Now, SPY is trading at $299.99, so that means that the call is going to expire out of the money. The option is not exercised, nothing happens, and you keep that credit of $125. Now, from another perspective, if SPY is trading at $305 instead of the $299 from the previous example, it is in the money, and so you're going to be responsible for making up the difference. So because this call option is expiring in the money, you're going to have to buy these shares at $305, which is going to be the market price. 305 times 100 shares equals $30,500. You now must immediately sell those shares for a loss. You're going to have to sell those shares for $300, which was the strike price of the option you sold, times the 100 shares. So you're going to get $30,000, which again is going to be a $500 loss. Now you did sell the option, so you did get $125 for giving the buyer that right. And so your actual loss is going to be that $500 plus the $125 you got, and that's going to be a $375 loss, which again is equal to the money that we looked at in the previous example where your $375 was profit. So again, just remember, if you're making money, someone else is losing money, and vice versa. It all equals out, regardless of which side you're on. So let's do the same thing, but with a put option. So SPY is trading at $300. You buy a put for $2 with a strike price of $300. Puts in general are going to be a slight bit higher than calls. I'm not going to get into why, but if you're interested in seeing a video about that, I could make one. Just leave a comment below. The price shown is on a per share basis, so that option is going to cost $200. SPY is now trading at $295 and the put is in the money. The option is now going to be exercised, and you would sell 100 shares of SPY for $300 even though the market price right now is $295. You would then immediately sell your shares and buy them back for a profit. So 300 times 100 shares is going to be $30,000, which is going to be how much you receive for selling those shares. Now, if you didn't have the shares to begin with, you would then have negative 100 shares in your account, and so you'd be required to immediately buy them back. So you spent $2 to buy the put, and then you would have to buy those shares back at $29,500. So again, that's going to be a profit of $500. You spent $200 to purchase the put, and so you'd be left with $300 of profit. So let's say it's trading at $300.01 instead of $295. The put is out of the money. The option is not exercised. It expires worthless. You paid $2 per share, so $2 times 100. You're going to have a $200 loss in this scenario. So now let's assume you sold a put. You sell a put for $2 with a strike price of $300. The price shown is on a per share basis, so you receive $200. SPY is now trading at 301 penny, and the put is out of the money. The option is not exercised, and you are not required to buy 100 shares of SPY for $300. You receive $2 for selling the put, so your profit is just going to be the $2 times 100 shares equals $200 profit. So let's imagine SPY is now trading at $295 instead of that $300, and the put is now in the money. The option is going to be exercised, and you're forced to buy 100 shares of SPY for the strike price, which was $300. Now, $300 times 100 shares is going to be $30,000. So you now must immediately buy shares for that $300 price each. Now, we'll assume you immediately sell them back to the market for $295 each, which again is the market price. So you're going to have what you paid, which is the 300 times 100 shares equals 30,000. And then you're going to receive 29,500, which is going to be 295 times 100 shares. So what you received minus what you paid is going to give you a negative $500 balance, but you received $2 to sell that put. So your actual loss is only going to be $300. So up next, we're going to be talking about covered calls, naked calls, and cash secured puts. I didn't get too much into the practical side of option trading. This was mainly just an introduction, trying to cover the theoretical side and trying to kind of help beginners understand exactly what's going on with an option trade as it expires and how people make money with that. In reality, you normally don't hold an option till expiration. In reality, you probably aren't going to be allowed to sell a call without the shares as collateral. If you can, you have to have a very large account. If you use Robinhood, which I know many people do now, they don't let you unless you have that 100 shares as collateral. Again, I'll get into all of this in future videos. This was just supposed to be an introduction, theoretical, to kind of sort of lay the groundwork. And the future videos will help put everything together and understand exactly how it all works and how you can take advantage of it all. So I'll see you next time. Thanks for watching. Don't forget to comment, like, subscribe, all of it. Thanks for watching, and stay tuned for the next episode of Money with Michael. I have lots of option videos coming.